You're listening to the Goldnomics Podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hello and welcome to episode 5 of the Goldnomics Podcast, where we're looking at developments in global financial markets through the lens of precious metals. And I'd just like to remind you before we start that to stay up to date with all of our podcasts as they come out on a monthly basis, you can subscribe to us on YouTube, on iTunes, and on SoundCloud as well, and stay up to date with everything in the precious metals arena by signing up for our newsletter on GoldCore.com. Now, I'm Dave Russell, and I'm joined as usual by our world-renowned precious metals expert, Marco Byrne.
Hi, Dave.
And CEO of GoldCore, Stephen Flood. And
hi, everybody.
Our topic for discussion this month is in gold, silver, and Bitcoin we trust, ? And to help us to discuss this, we have a very special guest with us this podcast, and it's Ronald-Peter Stoferle. And Ronnie is the managing partner of a fund manager called Incrementum Asset Managers based in Lichtenstein. That's easy for you to say. And Incrementum is a fund and wealth manager, and Ronni manages one of the funds there, or manages the fund that is based on the principle of the Austrian School of Economics. And Ronnie's research and his comprehensive In Gold We Trust report is respected internationally and a must-read for all gold investors. So, welcome, Ronnie.
Thanks for having me, gentlemen. It's a great pleasure.
Great. And Ronnie, we published, we shared your report, the In Gold We Trust report, which has been going for, you've been doing this for how many years now?
12 years. 12 years already.
Right, Steve. I thought it was 9. Well done. Yeah, I thought 2009.
12 years.
Wow.
And the most recent one now has been published within the last month or so. And bringing around to our topic of conversation for the day in gold, silver, and Bitcoin we trust, you particularly looked at 3 key findings, and you referred to them as your 3 tides of change when it comes to the financial markets and their effect predominantly on the precious metals markets. What are those 3 tides specifically?
Yeah, as you know, the 2018 edition of the In Gold We Trust report is quite a brick again. It's 230 pages, and the leitmotif of the report is the turning of the tide. So the 3 tides are. The 3 tides that are turning are, first of all, in monetary policy. We are seeing that this liquidity party that we're having for 10 years now, those 15 trillion that were printed out of thin air by central banks, this liquidity party is ending. So what we're seeing is that the Federal Reserve is implementing their quantitative tightening. It's for this year, it's going to be 420 billion, but next year it will already be 600 billion. So starting in October 2018, every month, 50 billion of US dollars will be the reduction from the monetary base. So this is per definition deflationary, and it's not only the Federal Reserve that is tightening. It is also kind of, although with quite some time lag, the European Central Bank. It's also the Japanese that might become hawkish, etc. So the thing is, most people underestimated the consequences of quantitative easing. It had tremendous effects on valuations of asset prices, stocks, bonds, real estate all over the world, creating this everything bubble. Now, the thing is, if quantitative easing had positive effects, why shouldn't quantitative tightening have negative effects for the valuation and prices of those asset classes? And I think that's something that the market is completely underestimating at the moment. The second thing, which is bit more longer term, I would say, is the de-dollarization. We're seeing that this de-dollarization is getting stronger. We're seeing that geopolitical tensions are also going strong. And from my point of view, they're often based on economic problems that we're facing due to our monetary system that was basically implemented in 1971 when we changed to a complete fiat money system. I think this system is at the verge of ending, and this de-dollarization is a long process. We're seeing that most of the emerging market countries are constantly buying gold. It's not only Russia or China, of course. It's also, of course, India, it's Turkey, it's Kazakhstan, and so on. Those countries are diversifying out of the US dollar into gold. And the third thing is, of course, about cryptocurrencies. Of course, cryptos have been stealing the show from gold, and many people in the gold industry do regard cryptos and especially Bitcoin as an enemy for gold. From my point of view, there's many applications being introduced at the moment that show that they should both be viewed as more complementary rather than incompatible assets. So I think that's a very important point that we're making here. Millennials that are very of course interested in technology and that probably wouldn't go to a bank and buy physical gold because some of them obviously have never been entering a bank in their lifetime. I think for them it's extremely important to get an alternative way to buy physical gold. And I think the combination of crypto and blockchain technology and gold totally makes sense.
Right. Okay. So we got our three ties. Let's have a look a bit more detail at the monetary policy one for a couple of minutes and bring you in on this, Mark. You've read the report, the full report. What's your take on the monetary policy tide change?
First of all, I'd just like to say congratulations to Ronni on another excellent report. It really is. It is a must read, as we said, because it sort of ties together. There's so many things going on in the wider markets, but also in the gold market. And Ronni and his partner Mark do a great job at just joining the dots and bringing it all together. And it's a great report. It's a must read every year, as you said, Dave. And it really is comprehensive. And I think anybody, even the most skeptical person, anti-gold person in the world, would read that report and go, okay, the guys have made a great analytical database, very empirical, all fact-based, very, very little opinion actually, because it's all the data there, it's all the facts, and they've done a really, really great job. I met Ronni first I think it was in 2000, we first published the report in 2009 because it was so comprehensive when he was with Erste Bank, and I met Ronni in 2012, and it's just every year I think it's actually getting better, And this year what I love about it is the three teams and the tides, and we know in Ireland we're a small little island nation, and we know the power of the sea, and when the tide comes in and when the tide goes out, it's a very, very powerful dynamic. And when the tide goes out, as Warren Buffett says, you find out who's been swimming naked when the tide goes out, and I think a lot of people are going to be found naked now in the coming months. So to get into the monetary policy, it's what I thought was great about the report is he focused on the monetary policy and then the monetary order, and it's in the day-to-day media coverage of the gold market and indeed the wider financial markets. The focus is solely on the monetary policy, and these days it's actually solely on what the Fed will do, and to a lesser extent what the ECB and the Bank of England and the Bank of Japan will do in terms of their monthly rate, their meetings, their interest rate meetings. And all the media gets all worked up. Is the Fed going to increase by 25 basis points or 50 basis points or whatever it is, But they're completely ignoring the elephant in the room. And Ronnie's report just showed it very clearly, the powerful effects that quantitative easing was on all our economies and indeed all the various asset classes, creating this everything bubble that we've covered before in the podcast. And now we're going to see...
We covered that one back in episode 2, I think, didn't we?
Exactly. And now we're going to see the flip side of that. And it's amazing that people, as Ronnie said, that people aren't realizing, there's massive positive effect on one hand, and obviously there's going to be a negative effect when this stimulus is withdrawn, if they manage to withdraw, because I think they'll struggle to do it. I think it will lead to deflation in the short term, potentially, and then they may need to go back to quantitative easing, So that's I think that's a fundamental thing. And Ronnie had a great chart actually showing exactly what he spoke about there. Which was, you see the combined increase in the balance sheet of all the central banks rising, and now it's the top of the curve, and we're beginning to come down the other side, and it's quite precipitous actually, and I think it's going to have a quite significant impact on all the markets, and particularly I would think that the bond market, So it's fascinating, and then the monetary order is something that people don't cover at all, in terms of the dollar as a reserve currency of the world, and Bretton Woods, and that is every day you see a new headline comes across the wires showing how that is slowly changing. We're moving to a multipolar world of many currencies,
Before we move on to that, I'll just bring Steve in on this, because Steve, this is something that you have talked about quite eloquently over the last number of podcasts, which is just the vast amount of liquidity that we have seen in the world over the last, particularly over the last 10 years, and how that's going to factor into the gold price going forward. How do you see that at this stage?
Yeah, I mean, like it's congratulations on the report, Ronnie. It's an amazing achievement, and your credit
Thanks
to your industry and to everyone else. I mean, if we're ever going to get ourselves out of this problem, this man-made problem, it's through knowledge, it's through insights, it's through research and fact-based decisions, evidence-based decisions, and this report is something that's it's now on everyone's desk and everyone's looking at it, and it's helping to focus people, more than ever. I thought it was fascinating in terms of your question there, Dave. Yeah, I mean, like, listen, it's a Pandora's box. They've opened it up. They solved a problem many years ago, a debt-based problem, and they basically created an enormous amount of liquidity. It's washed its way into every major market. It's an everything bubble, and now the problem is, how do you take that? How do you deflate that bubble and not blow up the system? And they're looking at, it's a double-edged sword. They're looking at a massive inflation threat and all of the problems that brings, and yet they're trying to deleverage as fast as possible, but as safely as possible. And this, maybe they'll get away with it. I don't know, but it's going to be a fascinating period of time to watch. We're in uncharted territory. There is every asset class is appreciated, but I think on the other side, in terms of the political landscape, in terms of the middle classes right across the West, and maybe to a lesser extent in the East, many people haven't felt the benefits directly of these everything bubbles in their own financial balance sheets. They have a lot. Their assets may have gone up, but their debt has also gone up. As countries, as sovereigns, our debt has gone up too. And I think you show it in the report too. The debt to GDP is up around 330 odd %, whereas at 260 or 270% at the last crises. But I thought the report was fascinating. I don't know what's going to happen. I think if you look at the political backdrop, these last few years, it's almost in its own bubble. It's the market's progressing at one, as if everything's fine. You have more debt going on balance sheets, central banks expanding their balance sheets, and you have this political discourse that is anything but coherent. So it's I think they've created a serious monster, and now we need to see what happens. Gold will, I think, protect the average investor's balance sheet. I think the case for it has never been stronger. The price is pretty good, and it hasn't appreciated as much in percentage terms as other asset classes. So a lot of people are looking at it with a fresh interest now. I thought one of your interesting, I love all the quotes, by the way, at the left hand side. I think they really make the report too. Because it gets quite heavy, and you have those quotes there, and they're quite entertaining. But I thought the world currency analysis was quite interesting when you look at the trade weighted currency of gold over time. I think it's nowhere near. It hasn't. It's still fairly valued, and it hasn't. And the precipitous drop wasn't as precipitous as it might be measured purely in dollars, as many people and analysts look at. And also, when you look at the average price of gold over those periods of time, it doesn't look like it's as volatile as well as many people might think. So it's a fantastic piece of work, and my clients are talking about it. Our clients are talking about it all the time. I had a few of them. We mentioned they saw the tweet we sent out the other day that we're going to have the superstar Ronnie on the podcast, and they're going through the report all weekend and get some questions to us as well.
So Ronnie, let me just ask you then, just in relation to this particular tide, as you call it, how is this going to affect the gold price? What's the effect on the gold price going to be, and how is that actually going to happen? How do we tie that particular tide back to what's going to happen in the gold price going forward?
Well, I think that many people have been quite disappointed with gold the last couple of years, and actually QE3 didn't have any major impact on gold, and I think that we should not forget that gold rose from $200 up to $1,900. And of course, the whole central bank actions were also a main reason of that. We have seen mostly negative real interest rates during that time. So it seems that after this huge bull market, people expected just too much, and we're quoting one of the colleagues that are most respected in the industry, Adrian Day, and he said people expect too much from gold at the moment. And I thought about that for quite a while, and it's such a brilliant statement, because it's very easy. Yeah? It's very intuitive to understand. The reason why I like it is we should not forget that equity markets are trading at or close to their all-time highs. Bond markets, corporate bond, but also sovereign debt, still doing well. Alternative assets like private equity and so on, art market, still doing extremely well. Real estate all over the globe, going crazy. We're seeing that the Fed is raising rates, that the Fed will is implementing QT, and that also the other central banks are becoming more hawkish. We're seeing that price inflation is not a big problem yet, and we're seeing that cryptos are stealing the show from gold. So if you factor in all those topics, I think that people they expect too much from gold, because per definition it's probably not an environment where gold should be doing very, very well. So the question is, when will this headwind that we're seeing from the other asset markets, when will this become a tailwind? Because I think the moment when the Fed will have to say, okay, the emperor has no clothes, this monetary policy normalization does not work, as soon as recessionary fears come up, as soon as the stock market will become more volatile and enters a bear market, this is going to be the point in time when gold will really take off. And this is going to be the time when gold will hedge other asset classes. But we're not there yet. And I think it's very, very important to say, if we see such a turning of the tide in asset markets, what distinguishes the current phase decidedly from the run-up to earlier big stock exchange crashes like 1929, 87, 2000, and 2008 is that we're seeing simultaneously high valuations of stocks and bonds. Because previously, bonds would help contain any losses on the stock market because they were negatively correlated to equities. However, at the moment, bond valuations have climbed into extremely thin air at this point. We're quoting a great study that analyzed bond market returns since the year 1400, and it showed that this is the second most extreme bull market in bonds since the year 1400. So the question is, as soon as equities and bonds take a dive and enter a bear market, what's going to be the safe haven? Is it going to be cash? Yeah, perhaps. Is it going to be real estate? I'm not sure about that. Is it going to be Bitcoin? Not sure. Bitcoin has to live through a whole business cycle and through a whole financial cycle. And I've got no clue how Bitcoin and cryptos will develop in the course of a market crash. Or is the safe haven going to be gold again? from my point of view, it's going to be gold. So as soon as we're seeing these headwinds becoming tailwinds, I think we're going to see big momentum in the gold market. I think that gold will take out all those resistances at 1360, 1380. And then the media will also pick up interested in gold again. Then all the private bankers, wealth managers will say, perhaps we should have some allocation to gold, 5 to 10%, exactly the same way that they had their allocations in gold, let's say, 2009, 2010.
Just on that allocation and those percentages that you're talking about there, from a private banker's point of view, saying to their clients, 5%, 10%. What are you saying to your clients? And are you saying now is the time to start to increase that allocation? Because effectively, if we look at gold as that financial insurance, well, that financial insurance is relatively cheap at this moment in time. So it is a good opportunity for us to start putting more financial insurance into a portfolio. Where's your allocation percentage advice at this moment in time?
Well, it's hard to give an estimate or recommendation. I think it clearly depends on the age of the whole structure of the portfolio of the client. Of course, our clients do have a significantly higher allocation to gold than most other asset managers would recommend. And our clients in the wealth management department have been doing very, very well, because they also had exposure to the stock market, to real estate markets, to the bond markets, of course. And this insurance, this golden insurance, we didn't really need that during that time. And we should not forget that gold in monetary terms got cheaper and cheaper, because the gold backing of the US dollar is probably at the same level like in 2000 and in 1971. So gold got cheaper due all to the monetary printing. So I just like buying cheap stuff. It's a bit like Warren Buffett once said. He said that if it comes whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down, and nobody cares about gold at the moment. We're quoting quite a lot of sentiment indicators, and you can tell that the market is between extreme pessimism, agony, bearishness. Nobody really cares about gold at the moment. It's extremely volatility is extremely low. So that's actually a point in time when, as a contrarian, which most of the market participants, of course, are not, but as a contrarian, you should have a close look at stuff like that. Negative sentiment in combination with the cheap valuation.
There was one indicator that you talked about in your report, which is Google queries for buy Bitcoin versus buy gold. Maybe you might talk about that for a second.
Yeah, as I've said before, the cryptos are stealing the show from gold. Of course, if I would be a journalist and I have to sell my story, of course, I would probably go for Bitcoin, because if you write price target 50,000, Bitcoin is going to explode. That's a headline that people obviously want to read. Yes. While if you say, gold could go to 1380 in the next couple of weeks, that's nobody's really interested.
It's not exciting.
Exactly. So I think the fact that the Google search term by Bitcoin was more popular than search term by gold. That shows quite a lot. That shows that the sentiment was very negative about gold, and it's not only the media sentiment. It's not only analysts. Analysts basically say that in the next 3 to 4 years, the price of gold will go sideways. So that's the big market consensus. Nobody has a strong opinion. Remember back in 2011, every big Wall Street bank was extremely bullish on gold. Citi, JP Morgan, they had price targets between $2,500 and $3,000. At the moment, we're far away from that. And that makes me pretty confident. But of course, we have to see some catalysts. And from my point of view, a recession and or inflation will be the main drivers.
Right, and I gather that when it comes to Bitcoin, it's not a case of in Bitcoin we trust for you going forward. Then,
pardon? What do you mean?
I said I take it from how you're talking about Bitcoin. It's not a case of in Bitcoin we trust going forward, particularly when you talk about Bitcoin not having weathered a storm in the past. It's still relatively new and hasn't gone through the full gamut of economic cycles. So it's not a case of in Bitcoin we trust going forward.
Exactly. I mean, when it comes to cryptos, I have to say I'm not only from Austria, but I also very much adhere to the Austrian School of Economics, and therefore I really like competition, and I think competition makes the market more resilient, more anti-fragile, if you will, more robust, and I think. As Friedrich August von Hayek once said, why shouldn't we accept competition in currency markets as well? He wrote about the denationalization of money, and we had a very good interview with Dr. Richard Zundrich, who is the nephew of Hayek and also one of the world leading experts on Hayek's work. And he said, Hayek would be very, very favorable, very positive about this currency competition that is happening at the moment. Because, let's face it, the reason why cryptocurrencies were coming up and the reason why they're so popular is also a sign that the market is basically losing confidence in government money. I think it's clearly a sign that people are losing trust in our financial system, and I of course, and that's also what Mr. Zundrich said, that Hayek would prefer gold to Bitcoin. From my point of view, I think there's place for both. We're actually describing some combinations of new technology and the oldest monetary technology, gold. So from my point of view, it's a trial and error, a monetary trial and error process that we're in. There will be many errors. I think that 95% or more of all those cryptocurrencies that are in the market at the moment are bogus and will be wiped out in the next couple of years. But I think that there's more behind this new technology, and therefore, I mean, it doesn't make any sense to kind of fight it. It's there. Charlie Morris once said, Bitcoin is digital gold. I think there's very much about that, because Satoshi Nakamoto, if you read his white paper, you can tell that this guy really understands money. He understands the Austrian School of Economics. He understands the stock to flow ratio, and therefore, yeah, as I've said, I'm accepting this competition, and I think that cryptos and gold, they're kind of friends and not enemies.
Right. Okay. Steve, I just bring you in here on this point because this is something that's close to your heart as well. When it comes to Bitcoin and technologies moving forward, how do you see that development?
Yeah, I'd share what Ronnie said. I think we're in a kind of an experimental phase right now. I think the demand is coming from people and wishing to clear transactions cheaper and faster. We're very much locked into a financial system which takes its pound of flesh on every transaction. It's a big bloated organization with increasing regulation and costs that are transmitted through our economies. So why not use technologies to disrupt that, to create efficiencies, to create speed of payment and receipt. If I want to buy a magazine from a seller in China and it costs 30 cents or something like that, or subscription, I should be able to do that and not be charged 2 and 3% and have him charge another % or 2 on his side by his bank. So there's a great need for efficient payment technology. And then if you go back as to what money is supposed to be, it's supposed to be a unit of measure, a mechanism for transfer. I think we've lost faith in our government-backed currencies because they've abused their right. They've abused their position. They've now printed money, which essentially devalues the money in everybody's savings accounts. And after tax, you're being taxed again. And if you think about it, if a central banker says, listen, I have to protect the system here, so I'm going to do some unorthodox things. I'm going to print money, and in the future we're going to take it back, and everything's going to be fine. But in the act of printing money, he's acting like a taxman, and he's not elected; he's appointed. And to me, that's a tyranny in all but name. So what you're seeing is the effects of that abuse of power by central banks. They have assisted and helped their chosen friends and friends in private equity markets and whatnot. It hasn't trickled down into the real economy. In some places it has, in other places it hasn't. People are not feeling richer, they're not feeling more secure in their employment, and they're voting accordingly. So it's creating disruption. And I actually would put all this at all the problems that we're facing around the world in terms of discontent at the feet of central bankers who have acted like gods, and that's where we are. So I think Bitcoin is one part, or blockchain is one part of that story, and I think it's very telling in the times that we live in that it has had such wide acceptance in such a short period of time. It has faced headwinds as well in terms of clearing systems and abuse in terms of key providers who clear these transactions and slow them down and charge lots of transaction costs. But this is a phase we're going through. We're experimenting with new technologies and payment systems that are used on the backbone of our internet. And I think gold has a very, very important role in its credential as a safe haven asset that can't be printed and abused and infinitely printed. And I think that there's so many crossovers there. It's so fascinating. It's a big part of our conversation here at GoldCore, and I think it will be for the years to come.
Right. Ronnie, in our last episode, we covered the topic saying that not all gold is equal, and it's important how you actually hold your gold. What do you see as being the best way for people to hold gold going forward, to own gold going forward?
Well, I think it should be a gold ETF issued by a big Wall Street bank. No, just kidding. That's just my weird sense of humor. That is kind of similar to the Irish sense of humor. I realized, yeah. No, I think you have to differentiate. That's what we always tell our clients. What's your motivation? What's your purpose? Why do you want to buy gold? Do you want to make performance? Of course, then you can go for mining stocks. You can go for paper gold, if you will. But if you really want to hedge, if you want to hedge against a big financial crisis, about a monetary reform, if you want to buy insurance for, I don't know, financial repression and all that kind of stuff, then of course you have to take care about counterparty risk. I always wonder why people expect a currency reform and then they go for a gold certificate. Yeah, that's ridiculous. So if you wanna really have insurance gold that we recommend our clients, you have to be very, very cautious when it comes to storage. You have to be very careful regarding the jurisdiction. We can tell that many of our clients and inquiries, they're all about geographical diversification. I think you guys at GoldCore, you put in quite a lot of work and thought regarding that topic about safe storage outside of the banking system. I think that's really, really crucial to understand, especially if you learn and study from monetary history like we do, and like we always want to kind of present the readers of our In Gold We Trust report. So I think that gold stored in a safe jurisdiction outside of the banking system, that should be a good idea going forward.
Awesome, excellent, thanks, Mark. I'll just bring you in on that just to help us wrap up here, because obviously that's very much what GoldCore is all about.
Yeah, absolutely. And thanks for saying that, Ronnie. Really appreciate it. I mean, that's very much what we specialize in. So just to go back to what Ronnie said about, and Steve said, I agree with what both the chaps said there about that, the nexus of gold and cryptocurrency and blockchain and fintech. And I think that it's a very, very powerful nexus. And it's terrible that there's been this whole thing of, pro-gold, anti-Bitcoin, pro-Bitcoin, anti-gold, instead of saying, well, hang on a second, there's a lot of real synergies there. I think the combination of the old and the tried and tested of gold as a safe haven asset and the new technologies is going to be very, very powerful, and there's a lot of people, competitors of ours and other companies that we work with and we know and respect who are working on this. And I think it's actually, and that's, I think 95 to 99% of these cryptocurrencies will probably go to zero and they'll be gone in 5-10 years. But there will be a few that'll be around, and a few they will evolve and they will transform into new iterations, and we'll see massive trade destruction. And the good cryptocurrencies and crypto bullion, I think asset-backed cryptocurrencies with gold and silver, actual physical bullion behind it, will do very well indeed. So yeah, and that's what we specialize in. We're looking at opportunities in that space. But yeah, we think gold is a safe haven asset. And it's exactly what Ronnie said about Bitcoin. The notion that Bitcoin is a store of value is just nonsense at this stage, And it's funny, the Bitcoin evangelists, they talk about Bitcoin as a medium of exchange. And then it became, it's no longer a medium of exchange because you're not going to spend your money on a pizza because the price has gone up so much. So then they start talking about Bitcoin as a store of value. But a store of value is something that it's created over decades and centuries and hundreds and thousands of years, and Bitcoin is not a store of value. Who knows? It may become in time. I think that there are certain risks to it becoming so, and obviously governments are going to be very slow to tolerate that. But yeah, the bottom line is I think it's an interesting asset. It could do very well indeed, but I think it should be a small part of a portfolio. I think you should conceivably have higher allocations to gold, but and especially for older people. I mean people who are about wealth preservation. Bitcoin should not be seen as a safe haven asset at this moment in time. It is more of a speculative asset, and that's why the millennials, they have more of a risk appetite, and that's why they very much like it, and they're familiar with the technology. So everybody should dip their toe in, own a tiny amount of Bitcoin, buy $10 or $50 or euros of Bitcoin, and because I think the technology is going to be around in some form, and I think it's a very, very exciting time. So, but I think the nexus, as I said, between the two is going to be very, very powerful indeed.
I have one last question there, Dave, if you don't mind, just for Ronnie. Just China, Renminbi-backed oil contracts, big news this year. What's the future hold in terms of the Chinese currency? The background being they have a lot of debt as well. What do you think what's going to happen with the gold price going forward? Their economy and the fact that they're moving into kind of reserve currency status.
Yeah, well, of course, China. I think if you combine, if you make the comparison about strategy between China and the US, the national sport or the national game in China is Go, which is a very, very strategic game to play, while the national sport in the US is, It's basically baseball or football, which is very much more focused on a short-term hit and run. And I think this analogy kind of makes sense also in a broader perspective when it comes to this de-dollarization. I think that the US, they know that the time of the US dollar, the best time is basically over, and they know that there's big competitors coming up, not only China but also Russia. I think it's no coincidence that the first trip of Donald Trump abroad went to Saudi Arabia, because of course they're one of his closest and most important allies, and of course supporters of the petro-dollar system. And I think this petro yuan, it represents the intersection of the dying petro-dollar and an ascendant renminbi, and that's a long process, as I've said before. I think that this year, but also last year, we have seen major steps in this de-dollarization game. We have seen the gold exchange, but especially now with the oil exchange in Shanghai, where volumes are much bigger than anticipated. I think those were really big steps in this whole de-dollarization game, and we should not forget all those competitors of the US dollar, all those growing economies with very favorable demographics. Not so China, but still, they are buying gold, and we always said that gold is going to the most productive, most innovative, most prosperous nations, and it's flowing from the west to the east. And yeah, exactly. So I think that's a long process. We're seeing that not only central banks, but also private people, private individuals in those countries are constantly buying gold. The Russians, for example, they nowadays have by far the highest gold backing of their currency, the ruble. We're seeing so many deals being signed between net oil exporters and China, basically circumventing the US dollar. So I think the US and especially Donald Trump, they kind of realized that the best days for the dollar are over. But of course, they just won't say, okay, we've lost this privilege of having the world reserve currency. Let's move over to the next currency system. So I think that might also be a trigger that geopolitical tensions are rising at the moment. I think you can say that many problems that we're facing on a geopolitical from a geopolitical point of view are actually based on the fundamental flaws of our currency system. Unfortunately, everybody is always looking only at the symptoms. Nobody cares about the real reasons. But from my point of view, and I think you guys will probably agree to that, many of the reasons of the problems that we're facing nowadays can be traced back to 15th of August, 1971.
Nixon, yeah.
Okay, gents. Well, that's about all we have time for this episode of the Goldnomics Podcast. It just leaves me to say thank you, a very special thank you to our special guest today, Ronald-Peter Stoferle from Incrementum. Ronnie, thank you very much. It's been absolutely brilliant having you on the podcast this month. Thank you very much.
Thank you guys very much. Thanks a lot. And I think now we can all really look forward to the World Cup, because neither Ireland nor Austria qualified.
And what we'll do is we'll link again to Ronnie's report in the show notes from this podcast, and to other aspects that we have mentioned, and we'll put up a few of the charts if we can as well, just intermittent in this conversation. So thank you again, Ronnie, Steve, Mark. Thank you very much, gents, for this episode. And I just want to finish by reminding everybody to subscribe on YouTube. You can follow us on iTunes, on SoundCloud as well. Subscribe wherever it is that you like. We'll be bringing you more content again. We're trying to get a podcast out at least once a month at this stage. And so if you have any questions, comments, or anything, stick them in the comment box below. Anything that you'd like us to cover in the future as well, anything gold related. As we say, the Goldnomics Podcast, looking at global financial market developments through the lens of precious metals. And that's what we've been doing again today. So goodbye, and thank you all for listening and watching.
Thanks,
you.
Ronnie.
Thanks,
David. Thanks very much.
Bye,
everyone.
Bye.
Thanks.
You're listening to the Goldnomics Podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed.